panel. We've got lots to discuss, especially given all the uncertainty surrounding the global economic outlook at present. Over the next hour, we're going to be touching on views on China, future of the European project, the views for the US, including interest rates and the dollar. If we've got time, commodities and negative interest rates. And we're also going to have about 10 to 15 minutes towards the end for questions from the audience. I'd like to begin with the broad global growth outlook. Coming into this year, we had a very bad start with equity markets tanking and talk of a global recession. Things seem to have stabilised since then. Sentiment has recovered somewhat. I'd like to begin with you, Charles. Where do you stand? Do you think observers are too concerned or not concerned enough?
Well, we're on the bullish end as far as the sort of 12 to 18 month view is concerned. The basic point is an analogy with 1986 and 1987 to 9, when we had the oil price crash at that time by slightly less than has happened recently, but about the same order of magnitude. We all said, okay guys, hats off, end of the oil crisis, so it's boom boom time, whereupon we had the mid-decade slowdown. And just as the economists have finished revising down their forecast to reflect the slowdown, boom boom time arrived in 1987 as people decided, yeah, well, as a matter of fact, the oil price cut's going to stay, so let's go out and spend the windfall. And then, of course, sooner or later we got into a high leverage crisis in 1989-90, but that was years later. Now, what we've been through this time is a much bigger tanking of oil prices, coal prices, iron ore prices, and of course the prices coming out of China, where the producer price deflation is running at about 5 or 6%, as well as the yuan going down. So the immediate pain, which produces the slowdown of oil producers, is also reflected in anyone who's selling anything to China and a whole heap of other aspects of world trade. And so the slowdown patch is longer than was the case then, but on the other hand, there is this gigantic windfall. The Chinese producer prices basically set the price level for the world, and they're coming down, which means that consumers are getting better off. And since we've been at a record high world savings rate for the last 4 or 5 years, at a time when the investment corresponding to that was essentially zero return and unnecessary, a transfer of income to consumers on the scale that we've seen recently, which is about 2% of world GDP, will tend to mean that consumer spending can and will continue to expand without an increase of debt. And that has been, the absence of that has been the main inhibition to the recovery since the crisis 7 or 8 years ago. So one way or another, we think that we're not talking about boom boom time this time around, but it's certainly a moderately optimistic view.
Okay, Russell, would you agree with that sort of cautious optimism?
No. So I think we're living through a structural change. So we can analyse the business cycle, or we can focus on the structural change. The structural changes are very rare. They don't happen very often, and that's why we tend not to forecast them or invest for them. And I would argue the last one, you could maybe date it to the fall of the Berlin Wall, but probably more accurately to the end of the Bretton Woods Agreement. So I think we're living through a similar event to the end of the Bretton Woods Agreement, which was a breakdown in the global monetary system. And I think that's what we have. This system was never put together in a room. It was cobbled together by emerging markets who devalued their exchange rates and then linked them in very, very competitive levels. It's produced massive imbalances because those levels were so competitive. The free movement of capital in this system, which didn't exist in Bretton Woods, has further exacerbated the imbalances. And by that I particularly mean the build-up of debt in the emerging markets who are running far too loose a monetary policy. And what we're witnessing is a shift of capital back the other way, and that is throwing up the fragility in this system. Add to that the decline in commodity prices, and I think we'd have a credit event. And the most important thing of all of that is not the credit event, which clearly impacts the stability of the global financial system, the flow of credit, and the creation of money, but it's the political response to that. And this will go down in the history books, not for that event, but for the policy that follows. And whether it's Adair Turner's outright monetary financing, or Christine Lagarde's capital controls, all of which are now back on the agenda. We, I think, in the next year or two will have to live through that. And getting that bit right will ultimately be much more important than the business cycle. So we're just one of those rare structural breaks, and I would focus on structural issues rather than the normal cyclical analysis.
Thank you, very punchy views. So do you think this crisis will prompt a sort of coordinated response from the world powers?
Yes, but that's the problem. It won't be from central bankers, it'll be from governments. Central bankers are, in my opinion, virtually played out. I mean, this Tobin tax, which the Chinese mentioned yesterday, Christine Lagarde's speech 3 weeks ago at Maryland talking about safer capital flows and capital controls, it gives you the agenda. And the agenda is clearly a step beyond central banking. So everybody in our business thinks that you can only make money from the response. The response is always more money, and if you own assets, you can only benefit from that. But if the next level of response is government interference with the price mechanism, no, we can actually lose money from the next response.
Okay, one of the big dynamics in the global economy is obviously China, and I want to shift the conversation towards China, and I'd like to ask Julian, do you expect a hard or a soft landing for China, and what are the implications for the global economy?
Well, I'll come to that in a second. If I could just pick up on something that Russell was talking about, which I think is a variation of the idea that what we're seeing now is the third leg of the global financial crisis that began in 2007, 2008. Obviously, the first leg was the collapse of the subprime mortgage market in the US and the problems in the Anglo-Saxon world that resulted from that. The second leg was the Eurozone crisis of 2011-2012, when the region came close to breaking apart. And then the third leg, arguably, is the slowdown that we're seeing in emerging markets generally, including China. And that's partly perhaps a response to the first two legs, when central banks in the advanced economies loosened monetary policy very aggressively, that encouraged a lot of capital to flow towards emerging markets, causing a boom in credit and now arguably a bust. So maybe that's the negative perspective on what's going on now. That said, I think a lot of those concerns are overdone. If you do look at debt levels across the emerging world, actually debt-GDP ratios are typically much lower than those in advanced economies, including in China. It is true there has been rapid growth in credit, so if you're looking at the rate of change of the amount of credit out there, then that does look quite scary. But we're still at levels that would be considered quite acceptable in an advanced economy. What's more, of course, the emerging world, by and large, has other advantages. It is a region which will continue to grow relatively strongly. Clearly, it's much better to have a debt-GDP ratio of 250% if you've got an economy growing at 5 or 6% in nominal terms than one like the US or Europe, which might be nearer 2 or 3%. You also have still plenty of scope for policymakers in the developing world to stimulate growth. They can still cut rates a lot further and do more on fiscal policy. And also in the case of China in particular, we know the problem in the Western economies is that banks refuse to lend if there's a liquidity crisis. That option is not available to a state-owned bank in China. You will be told to lend, or else the penalties are pretty severe, the sort of thing that Mervyn King would have loved to have had available. Those tools are available in China. So I don't buy the idea that we're facing a third leg of the global financial crisis. On China specifically, will there be a hard landing? Well, I think in a sense there already has been. I mean, it depends what you mean, of course, by a hard landing, but most people in the Chinese context might talk of growth slowing from 10% to maybe 4%. We actually think that already happened. I don't think anybody believes the official GDP numbers, but our own in-house estimates suggest that GDP growth probably slowed to about 4% at the beginning of 2015, and since then it's been fairly stable. More recently, there have been signs of a pickup, at least in leading indicators like credit growth. Not necessarily good for the long term, of course, because we know China has a problem with credit and property bubbles. But I actually think the hard landing that many people fear may already have happened, and from here, growth will pick up again. If we are wrong, though, I don't actually think it's the end of the world. Obviously, other things being equal, if China's growth slows from 10% to 4%, that means a smaller contribution to global growth than there was before. But I don't think anybody realistically could have expected China's economy to continue growing at 10%. 4 or 5% actually ain't bad for an economy at China's stage of development. What's more, China's economy, of course, is now a lot bigger. So in terms of contribution to global growth, 4% or 5% now is actually pretty similar to 10% a few years ago. The big impacts, if China does continue to weaken, I think will come through commodity prices. Though arguably commodity prices have already fallen a long way and they have scope to recover. And then the other potential shock, of course, is the devaluation of the renminbi. Maybe we might come back to that later. But for once, I believe the People's Bank of China. When it says it's targeting a stable exchange rate on a trade-weighted basis, and that's pretty much what's happened over the last year, I'd actually tend to believe them. So I'm not expecting a big devaluation of the renminbi, but that could be the big shock if we're wrong over the next few years.
Okay, Ian, would you agree with that view that China's past its worst?
Yes, I think that that's a view that we would definitely share. And I think that it's driven by a number of things. Firstly, that we actually see China almost as a symptom of one of the bigger trends that's out there that perhaps links into Russell's idea as well, which is that it's the strong dollar. The strong dollar kills traded goods prices, kills traded goods activity, and although China has been rebalancing towards more of a service-driven economy, you can draw a very nice chart that shows nominal GDP growth in China and the change in the US dollar, and obviously until recently the RMB's been pegged. And that has been one of the things that's really dragged down the Chinese economy. What we're now seeing is that willingness, as Julian was highlighting, to see a more balanced approach to the exchange rate regime. Our sense is that the devaluation that they're looking for, given that the real effective exchange rate between the dollar and the RMB have actually been very stable over the last 5 years, the big divergence has been between the RMB and Asian currencies, and RMB and Euro. So, for us, it's actually about China trying to regain some competitiveness against the rest of Asia and perhaps against Europe. But what we're seeing, our sense is at Absolute Strategy, that there's a very strong willingness to stop that growth slowdown. One through monetary policy, directly through liquidity expansion. Secondly, fiscal policy, and of course through the exchange rate policy. So, given that you're seeing loosening on all of those counts, I think that the probability that you see some stabilisation in Chinese growth is actually quite high. And we go as far as to say we think that Chinese growth is going to re-accelerate faster than US nominal growth. But taking it back slightly to the first question, we think you're in a push-me volume economy. In a world of zero interest rates, a lot of the transmission mechanism goes through FX, and that's a zero-sum game. So every time you get winners in one region, our activity surprise indicators show that you get weakness in other regions, and so the net effect is that we're going sideways. So I'd be slightly in between Charles and Russell from that point of view. We think the danger is that until we get more concerted fiscal, monetary, and macroprudential and microprudential easing, we're still stuck in this very muted, financially repressed cycle. The one thing about China as well, coming back with something that Charles was saying, we'd also agree that oil is a big benefit for emerging economies, or many of these emerging economies. So lower oil prices actually would also give us a sense that China is a bit of a beneficiary there.
I'd say something about China. We calculate Chinese GDP using their own price data because there's an obvious sort of distortion in the numbers they publish in the World Growth. And we come up with about 3% for the last year and a half as having been real GDP growth rate. And that's probably going to continue for several years because what you have as of a year or so back is that capital spending was about 46-47% of GDP, which is insane. And that has to come down a long way. And when 46% comes down a long way, other things get dragged down too. Nevertheless, if you've got 3% growth with 46% falling, then the 54% has got to be doing quite well. And in fact, Chinese exports are doing quite well in real terms. And on top of that, Chinese consumer spending is doing quite well, which gets back to the point about consumers worldwide doing nicely. If you just analyze the data in a numerical kind of way, in the good old days when China was growing 10%, consumer spending was only growing 7% because it was losing share all the time. now that China is probably growing at 3 or 4%, consumer spending is growing faster, i.e. 5 or 6%. So it's scarcely any slower than it was before, which means that the transition will be both prolonged and relatively soft in terms of its social impact. Hard, obviously, in terms of its impact on the rest of the world to start with, of course, benefiting people's real incomes as consumers in China and elsewhere. And if you look at the Chinese demographics, which of course have slowed down, then per head of population, the growth rate of consumer spending and consumer income now, in real terms, is about the same as it was in the fast growth days. So I think we have to sort of bear in mind the Chinese story is a medium-term story with a big adjustment to come, but the overall impact of this is likely to be benign for China, and they should. And I assert benign for the rest of the world, in that we all now depend on Chinese goods, which set the price level really for world goods, and they're coming down.
Thank you very much. I'd like to change the topic now over to Europe, and Russell, I'd be interested to hear your views. Can the European project survive given the Brexit vote and the migrant crisis?
No, I mean that's kind of a political question, which is I think something we'll come back to over and over again on this panel. But so much of what we're going to talk about has nothing to do with economics whatsoever. So it was never a political, sorry, it was never an economic experiment. It was always a 100% political experiment, and it can only die politically. It can never die economically. If they had to close every single market in Europe to sustain it, then they would. So the idea that you can analyse it economically, Greece is a perfect example. They virtually have closed every single market rather than change the nature of the whole thing. So yes, absolutely, Brexit. And I think one of the useful things when you're analysing politics, maybe not markets, is to jump forward 10 years and then say, if something happens, why would it be in the history books? And if we do vote for Brexit, I have no particularly strong opinion on it, but if we do, then it'll be in the history books because it triggered other referendums. Well, I think there's a debate on that. And that is absolutely key here. So my view, and it is a purely political view, and you can add what weight to that you want, is that if I was an incumbent in Europe, I would be offering my people a referendum on this. Because I'm going to lose my job. I'm going to lose it to Marine Le Pen, or I'm going to lose it to somebody else. You know, there are extreme left and extreme right who are basically saying we are sovereigntist parties, and we offer you sovereignty. And there's enough people in the country keen on sovereignty that I, as the incumbent, am probably going to lose my job. So the easy way for me to respond to that is to maintain my complete support for the euro and the European project, but to offer my people a referendum on the issue of what the new constitution for Europe would be like. So what does that mean for investors? Well, massive uncertainty, clearly. My view also is if we ever got to that stage, the temporary imposition of exchange controls of some form would be necessary. We're talking, Brexit is just us, we're not in the euro. If a member of the euro was ever involved in a referendum, the movements of capital within Europe would be absolutely massive. And I think they would use that. And there is a provision in the treaty at which you can use short-term capital flows. And they've done it obviously in Cyprus, they've done it in Greece. They're quite capable of doing it again. Now for what we do for a living, that would be the number one impact. Whether anybody votes to leave would be a different question. But in that intervening period, I think restrictions on the free movement of capital within Europe, difficult as it is, virtually impossible you might think, when you've all one currency, but still in place in Greece and Cyprus, then I think that is the outlook. In the long run, my own view, which is clearly biased because I'm British, is that they won't make it into a federal states of Europe. But I don't think that opinion is any more validity than anybody else's. But the referendum along the way is what we have to worry about in terms of uncertainty. And it would clearly slow economic growth if all this capital started taking bets on who will be in and who will be out.
Thank you very much. Charles, do you have any thoughts on Brexit or the European project?
Well, I mean, I sort of sympathise with what Russell has to say in his sort of 10-year view, that it's more likely the euro is going to break up rather than integrate, and it's got to do one or the other. As far as Brexit itself goes, which is about the EU, not about the euro, I think it matters a lot less than people imagine, certainly economically, in that the main point is that we're not in the euro. And the euro is the place where the ever closer union is being pursued in a serious kind of way. And we're not in Schengen, which sort of does the same sort of thing with political boundaries. And you know, the people of Germany and France and so forth have to ask themselves, if you don't have a currency and you don't have a border that you can enforce, are you a country at all, or just a municipality? And that's essentially the question that they're going to have to settle. We, on the other hand, are not in there and are not going to be in there, and so in that sense, the Brexit question, in its narrow sense, is less important. I must say that I'll repeat my optimism about the short term, because as a matter of fact, European consumer spending has been growing quite, well, let's say, at above trend rate for Europe, which of course is a very unimpressive starting point. For nearly 3 years now, since the spring of 2013. And the Eurozone as such has no oil production at all. So unlike the United States, there wasn't a sort of negative impact in the American case on shale fracking from the collapse of oil prices, although obviously the Arabs and the Russians source much of their imports from Europe, and so that slowed down exports a year or so back. And then the Germans suffered a little bit from the Chinese slowdown. Nevertheless, you're talking about an economy which before the devaluation of a year and a half ago already had a current account surplus of about $400 billion and another 100 billion bonus from the oil price. And this huge surplus economy is devaluing to create export-led growth. So there is actually a little bit of growth going on in Europe at the moment, rather surprisingly, from a very poor level. So I don't actually see this whole thing materializing as a problem in the short run, unless, as Russell suggests, the politics of Brexit cause that sort of disruption. If the British vote to stay in, as all the betting odds suggest they will, then you end up with disruption of Europe, which certainly will have medium-term consequences, because of once one country has an exception, why shouldn't everyone have an exception? But you know, that's something which will work itself out over a period of a few years rather than a few months.
Okay, you briefly touched on the comparison with the US, and I'd like to shift the conversation onto that topic. Ian, what's your outlook for growth and interest rates and the dollar and potentially the election as well?
I'm not sure about the, is that what? Thank you, Lisa. You know, I'm not sure about the election. You know, our sense is that you know, the US economy, you know, has seen a period of weakness over the last few months. You know, our surprise indicators are beginning to stabilise. You know, we're starting to see a bit of uptick. You know, what has clearly been dragging the US down is that dollar strength. You know, the 30% appreciation over the last 3 years impacted the commodity prices, and as we know, you know, for the first time, you know, for many years, the US has now been one of the world's largest oil producers. Any other oil-producing economy, if oil prices had come down to the degree that they have, you'd expect to see, you know, an impact on their economic activity. We've seen that, you know, when we split up our activity surprise indicators. You know, what you can see is that the industrial side of the US economy has been impacted very severely. But you know, we have a lot of sympathy with Charles's comment about US consumers actually getting a bit of an oil dividend. You know, that the consumer-related surprises have actually stayed very robust throughout this period. So, you know, there's a conundrum in America. It's a bipolar economy. If you use CapEx data, if you use industrial data, every time CapEx has been this weak over the last 40 years, there has been a recession in the United States. But unless you get real income growth decelerating very rapidly and consumer growth very rapidly, you've never had a recession in the United States. So one of those statistics is going to be you know, probably broken this time, unless we get a very sharp feed through from that industrial side into the real income data. Our sense is that it won't do, you know, but it's a relatively modest in growth environments. Indeed, our leading indicators, which unlike the OECD exclude financial market variables, are showing the US as the weakest region in the global economy at the current time. So, our sense is that it's a modest growth profile, but one that isn't going into recession. In fact, we give a very low weight to US recession. We give a very low weight to global recession. So I'll stop there on the real economy side.
Thank you. Julian, what's your view?
Is that working or not? Or has that died?
I think it is, yeah, maybe.
Was that one working at the back? It didn't sound like it. This one's working. What about Julian's?
Can I say something? Is this clear?
Yeah.
Okay, good.
All right.
Oh, okay. Well, I think the oil price story is critical here to what's been happening in the US, and it's an opportunity to talk about the impact of lower oil prices on the world economy as a whole. One way to think about the big fall in oil prices is that it transfers income from oil producers to oil consumers, and in principle that might be a net positive for the world economy on the assumption that consumers tend to spend more of their income than producers might do. Or at worst, it's neutral. It's simply a transfer of income from one part of the world or one part of the economy to another. In practice, though, what seems to have happened is that the negatives have come through much more quickly than the positives. And the US, of course, is a good example of this. You've had the very sharp fall in investment in the energy sector, knock-on effects on manufacturing compounded by the strength of the dollar. Whereas consumers have been relatively slow to spend their windfalls on other goods and services. Other short-term negatives in the fall of the oil price is partly simply the uncertainty that it's caused. To me, it's clear that the reason oil prices have fallen is issues on the supply side, the rapid increase in US supply and from within OPEC, particularly from Iraq, rather than any weakness in demand. But people have seen the big fall in oil prices and interpreted them as a sign the world economy is in trouble. And you also have potential knock-on effects to financial markets, obviously sovereign wealth funds reducing their asset holdings to support growth, and also knock-on effects to concerns about the US junk bond market, for example. But all of those are short-term uncertainties. That's one of the reasons why the US economy and the global economy has stuttered over the last few months. However, over time, I think the positives will start to win through. The big hit from lower oil prices on the energy sector is now past. If anything, oil prices now look like they've at least found a floor, even if not strongly recovering. And instead we see more of the benefits starting to come through in terms of pick up in consumer spending. And I think that will apply to the US as almost like a laboratory for this story, because it's both an oil producer and an oil consumer. But certainly for the world economy as a whole. So in answer to the question, are lower oil prices a good or a bad thing? I think in the short run, they're a bad thing. In the long run, though, they're a good thing, and we are moving into that long run period.
Thank you very much. Of course, one of the central questions within the oil price outlook is the dollar, and also this is very critical for the US outlook. Ian, what are your thoughts on the dollar?
Well, I think this is where we link in with some of Russell's concerns. I think that we're shaping up to see something of a Bretton Woods 3 type environment. The pressures that the strong dollar has created in the global economy have been immense. Every time in the past that you've seen this kind of 30% appreciation over 3 years or so, and a big divergence in real effective exchange rates, you've ended up seeing, as Russell was talking about, quite a cathartic process. However, that needn't necessarily be all bad news. Normally, we think that the dollar by 2020 will be something like 30% lower. And one of the questions that we're posing to our clients is how their portfolios will actually flourish in that environment, particularly if they're very defensively oriented, because historically that weaker dollar has been an environment where global liquidity has expanded, and actually the real economy has tended to pick up quite nicely. Only then do you get, at the end of that process, do you then get the 1987 type experiences or the more aggressive crashes. So, our sense is that the dollar looks as though it has peaked. If you look at the DXY over the last 12 months, that's been pretty flat. If you look at the broader indicators, those 3-year rates of change have peaked out at just about 30%, as they did in 1985, as they did in 1998. And we think that that the trend now is for a weaker dollar, particularly if the rest of the world picks up more aggressively than the United States.
On this one, I must say that the interesting thing at the moment is that everyone is convinced, and has become convinced over 30 or 40 years, that the capital movements are the thing that really matter. Current account doesn't matter. The one reason why I'm not too worried about the dollar is that I think it is now protected by the euro and by the yen. Specifically, the Eurozone had this huge current account surplus, and it's now beginning to increase again. Toss in Sweden, Switzerland, and Denmark, which are really part of that economy, and it's another 100 billion. So there's a massive inflow into the Eurozone, which Draghi is doing his best to drive away with fixed income, fixed capital outflows and QE, but he's failed, basically speaking. He was hoping to get the exchange rate down, and he hasn't succeeded. The underlying tendency is for more than $500 billion to be coming into the Eurozone on an annual basis. So it takes a constant capital outflow just to use that up, and less chance that will happen. When it comes to the yen, rather similar things happened. Owing to the fact that these guys simply cannot get their domestic spending going in Japan, they have a very weak pattern of imports, both in volume and again, of course, in prices because of the collapse of import prices globally. With a modest growth of exports, they are therefore in a position of very weak growth, and a huge current account surplus, and a restoration of Japan's position as a sort of safe haven. And so the yen has done the opposite of what Mr. Kuroda is trying to achieve, and has appreciated that. The result is that the US is to a degree protected in the current environment compared to where we were a year and a half ago, when it was the collapse of the yen followed by the collapse of the euro, which were concurrent with the collapse of oil prices and precipitated the story we've just been talking about. So as I see it, for the short term, we're in a relatively, and when I say short term, I mean a year and a half, we're in a relatively benign environment, currency-wise, and that the big, the dollar is protected, and the emerging markets, including China, have become rather more competitive, and therefore able to grow at a rate based on export rate.
The question that you've just asked us about the dollar is a question I once asked George Soros, and that's not to say I've only ever met him once, but I made the mistake of asking him, what do you think of the future for the dollar? To which he gave the reply I'll never forget. He said, don't be stupid, you can't forecast these things. And I think that's on the whole right. We know exchange rates are more difficult. I mean, they're expressing the preferences of millions of people every day. But we also know that Mr. Soros has made quite a lot of money from exchange rates. And I think what he is really saying is that they are unpredictable, except for some very rare circumstances. So there is one rare circumstance in which it would be predictable to say the dollar will be very strong, which is when you have forced buyers of the dollar. Now, history tells us that the time you get a forced buyer of the dollar is when there's global deleveraging. The dollar is borrowed cross-border by people who match it up with other income streams other than dollar income streams. And if the world starts to delever, the dollar tends to go up. And even in 2008, when it was America was the epicenter of the credit crisis, the dollar tended to strengthen, even though it was extreme monetary policy coming out of the United States of America. So I obviously believe that is what's going to happen. We are about to see it, despite the best efforts of the global central bankers, we are about to see a deleveraging driven not by their policy, but the significant decline in corporate cash flows, which is obviously very concentrated in the commodity sector at this stage. And a global deleveraging would send the dollar higher because of forced buyers, and I think we're just on the verge of that. Just one thing about the US economy, one thing I think we haven't focused on enough, is that since 1994, the vast bulk of the Treasury issuance has been funded by central bankers. Initially, the emerging market central bankers, and then in 2009, the Federal Reserve. And this, I think, is potentially very, very important, because the thing about a central banker when they buy a treasury is they don't have to sell anything. They create something. So from 1994 to 2009, emerging market central bankers created their own currency to fund the treasury market. From 2009, they continued, but were joined by the Federal Reserve. Now we've got a situation where I think it must be close to 50% of the entire treasury market now owned by people who are not savers. But they've stopped. The Fed has stopped. The foreign central bankers are liquidating their treasury positions. Who's buying? The only person left to buy are the savers. Now, crowding out is a phrase that I've laughed at for a generation. I think it's a kind of meaningless thing. But actually, because we've lived through this bizarre period, and now the central bankers are out, the savers, and this shows up in the flow of funds data from last week, are reallocating capital to fund the treasuries. And I think that is why in January we saw a spike in corporate bond yields, because they were selling corporate bonds, a decline in the equity market. And this is going to continue. American government's going to have to fund itself from savers. Now, obviously, the good thing is it could attract lots of global savings, and it seems to be somewhat successful in that. But a world where we move away from the world's largest economy, seeing its government funded by the creation of liabilities rather than savings, back to one where the savers have to fund it, I think is it's a significant slow-burning dislocation for the US economy.
Could I just very quickly come back on the dollar? I think we're agreed that forecasting currencies is a mug's game. I'm going to try it anyway. I personally think the dollar is going to strengthen further against other major currencies, but it will weaken against emerging market currencies. As far as the majors is concerned, that's basically driven by our view on monetary policy. We think the Fed will raise rates by significantly more than the markets anticipate over the next year or so. So that will support the dollar against the euro, which we expect to fall to parity, and against the yen, which we expect to drop back to about 130 against the dollar. In contrast, though, we think the emerging market economies have currencies have actually recovered, partly because we're less pessimistic than most people are on the underlying economies, partly because we see the commodity prices recovering a little bit further. And I include in that group, actually, China's renminbi. I think one of the surprises this year might be the renminbi appreciating against the dollar. And that is indeed the logic of this. I mean, if you believe that China is going to be targeting a broad stability on a trade-weighted basis, then if you plug in our various numbers, then we suggest the currency of China shouldn't fall that much. In fact, if anything, it might actually start to rise a little bit. So certainly not the big devaluation that many fear.
Thank you very much. I'm going to pause now and see if there are any questions from the audience. Gentleman at the back.
You want me to shout?
Yeah, seems like it. Sorry.
Okay. Well, just a hypothesis really, for you to answer perhaps, is that let's assume that Donald Trump gets into the White House. Could each of you give an opinion on what that might have in terms of effect on terms of each asset class? And there's a £10 fine if you say high volatility. So you give us some idea. Thanks. You give us some idea of what you think different asset classes will trend like on the assumption that he gets into office.
Right, far away here, yeah. Well, I mean, my hypothesis, as you can tell, is that Middle America is going to spend its windfall from cheaper gasoline. Once they fill the tank, they find they've got a bit more cash left in their pocket. And the kind of people who respond that way are the kind of people who are voting for Donald Trump. So if we're saying that they win, then I'm assuming that spending will be stronger and the US economy will do better on a consumer-led basis. And so we all obviously know that in this scenario we don't particularly like sectors like oil and gas and basic materials, but we like the job creation means people move from no wage to low wage, which helps consumer staples and retail. And the consumer discretionary, of course, does very well, and the media do fine because of the advertising. So you get a broad-based kind of story. In terms of the housing market, which is pretty lively, that's helpful too. So one way or another, I would say it's going to be good news for US stocks. except with the exception of sectors which are obviously hit by global developments. So on that basis, I would say you need to be moderately long. And the other thing to remember is that we've heard a lot about debt crises, but the Chinese capital outflow, which is currently running at $100 billion a month, is either to repay their own foreign currency debts, which is deleverage, or it is to buy real assets, particularly real estate, but of course from people who will then take their money and have to invest in something else. So the fears about a collapse of the PE ratio, which may well be a justified fears over a medium term, are unlikely to be all that realized in the context of the current Chinese appetite for real assets, which is a big change from the position when they were running big surpluses before the crisis.
Can I just sort of say something? So, I don't think it makes any difference. Which sounds really stupid, but Trump may be many things, but he's not an ideologue. So he's wearing the clothing of the ideologue because it helps you get elected, but he's ultimately a pragmatist. So I don't worry that he'll put up trade barriers and all that sort of thing, which is, I suppose is the great worry that he'll begin to reverse the globalization process, because everything he says tells you he's going to do that, but don't believe anything he says. I would say, however, that he has a unique skill and a unique talent which may be very, very useful for America going forward. And that is he's an expert at defaulting and restructuring debt.
I mean, I have a similar view. I think you can pretty much ignore most things that people say in election campaigns in any context, but particularly at the moment it seems in the US. I haven't followed the debate that closely, but every time Trump has come out and said something outrageous that might lead to a specific policy outcome, very quickly he seems to back down. So, for example, he sort of advocated torturing anybody remotely foreign and then said, but I won't force American soldiers to break international law. So he makes a big, bold statement and then backs down. You also have to ask what the counterfactual is. I mean, there are probably plenty of people on Wall Street who wouldn't be terribly enthusiastic about Hillary Clinton in the White House, or above all, of course, Bernie Sanders. And they have agendas that may not be very market-friendly as well. I mean, Hillary Clinton in particular has not been particularly pro-free trade, and of course Sanders would ramp up taxes on almost everything that moves. So I suspect you'll get some, I'm not going to use the V word, some uncertainty ahead of the poll, and additional uncertainty if Trump does win, not least because of the interregnum between him being elected and actually becoming president. But I'm sure he would move swiftly to appoint relatively sensible people to the key tasks, start back down from some of the more outrageous promises he's made, and it may well indeed not be the big deal that many people would fear.
And just very quickly, similarly, I don't think I've got any sense of what his economic policies are. But agreeing with Russell, the message that we get is he's a pragmatist, first and foremost. I think the one thing that I would say, though, is that what we have heard is a lot of isolationist. One of the strengths of America has been its migration, its willingness to grow via migration. And to the degree that he is more isolationist, our sense is that continues a trend that America has shown over the recent years, with the Fed becoming much more, and this is obviously a shift there from government to the Fed, but the sense that the Fed has become more focused on domestic policy and no longer wants to play the role of the world's central bank. So if this encourages a more domestically focused, a Trump presidency would encourage a more domestically focused monetary policy, then my concern is that you hasten the breakup of the role of the dollar as the world's reserve currency and a shift to the SDR, which is what Madame Lagarde seems to be pushing for at the current time.
Any other questions? Go ahead.
Julian, you mentioned about oil prices, and particularly in the US, you mentioned we've had the disadvantages before we get the advantages. Have you done the analysis of the consumer balance sheet to really see what the push and pulls are in terms of, are there offsets, be it increasing healthcare costs, rents, and then really drill that down by different age demographics to see, are there structural reasons why we wouldn't get this cyclical pickup in the consumer. So I'd be really interested to hear your thoughts on where the offsetting factors are and what the big items of the consumer balance sheet are and how they look.
Well, I mean, starting with the impact of lower oil prices, I think that it's understandable that consumers in the US have been slower to spend their windfalls than those, for example, in Europe, because of course many of those consumers may actually be working in the oil industry or sensitive to it in one way or another. In general, consumers in the US are more sensitive to what's happening to equity prices as well than those in Europe, so the initially negative effect of lower oil prices on the equity market has probably dampened consumer spending to a degree in the States more than it has done in Europe or Japan. In terms of more general fundamentals driving consumer spending in the US, I think the obvious thing to focus on is the labour market, which has continued to improve. The unemployment rate obviously has fallen sharply. There are broader measures of labour market slack that suggest there's still a fair amount of capacity to go, so things like the participation rate and broader measures of unemployment, but those are heading in the right direction as well. So I think over this year, you will see a further increase in the number of people employed in the US, and also a more marked pickup in wage inflation. So there's at least a couple of things there that should be strongly positive for consumer spending in the US. The benefit of lower oil prices still being there, and an improvement in the labour market. Now obviously that will vary by demographic, it'll vary depending on the sector that you're working in. But I think it's hard to tell a negative story for the outlook for consumer spending this year in the US, given those factors. And in particular on that windfall, it's been quite striking. If you look at the amount of money that consumers have saved from not spending so much on gasoline, that's almost exactly been mirrored in an increase in the amount that they have been saving. So the personal savings have shot up by that amount. Now, I simply don't believe that's sustainable. I mean, the US consumer is somebody who wants to spend. There may be some temporary factors holding them back, including the uncertainty generated by lower oil prices. But I'm pretty confident that provides substantial support to spending going forward.
Something here. I mean, the savings rate absolutely has gone up by 0.5% from sort of 4 3/4 before the oil price declined to about 5.25% now. If you do a long run, sort of 30-year tracking of the savings rate against household wealth, you find the savings rate should be about 3%. And this has been a pretty tight correlation until recently. So there is a lot of potential downswing there. In addition, if you take a look at the debt service ratio of owner-occupied households, you find that the debt service ratio at the moment is about 10%, or exactly 10%, right? Which happens to be the lowest on record, although admittedly the records only start in 1980. But the current position, partly because of interest rates, but also because of much reduced actual level of debt of US households, is more conservative than it was in the 80s and 90s when they had consumer booms. So all in all, there are good reasons to suppose that in the ordinary course of events, people respond to pain more quickly than they respond to the gain, but the response to the gain is the thing that will be coming through now.
Something very quickly. The savings rate data shows the US savings rate rises from 1952 to 1966. From 1966, these are in broad terms, declines to about 2009, and then it starts to rise. It strikes me that has a nice overlay with the growth of the baby boom generation. That as soon as they start getting wages, the first thing that happens, if you give a baby boomer $100 in wages, he spends $120. And now we have to, at some stage, reverse the levels of consumer debt that were built in. And short what I'm saying, the last 30 years of data for the savings rate may tell us nothing. All these correlations for the last 30 years, if they just relate to that period and shift in the baby boom generation. So I'm not saying that they are necessarily wrong, but I think we need to be cautious in saying that even, I believe in long run data, but even 30 years data may not fully encapsulate what's going to happen to the United States savings rate. And the crucial thing about it is if it keeps going up, the US current account deficit presumably keeps coming down, putting more and more pressure on everybody who's trading with the US.
And I'll just finish off by by saying one of the things that we try to do at Absolute Strategy is, find out the data ourselves. So we actually run a survey of US households every 6 months, and we actually, look at 10,000 households of different demographics across all the different regions, different political persuasions as well. So, looking at that data, the thing that is most obvious is that there are tremendous scars from the credit crunch. So the question, are you concerned about whether you're going to lose your job, even though unemployment has come down to 5%? People are as worried today about their possibility of losing their job as they were in July 2009. The other factor that comes out, particularly for that younger age group, is that student debt is a massive overhang. So the first call on student debt, which you can't write off in the United States, has been a tremendous drag on US consumption. And the rise in student debt since 2011, when the US authorities changed their regulatory stance towards the funding of US educational organisations, has, I think, been a big drag. And we would also highlight the data that Charles commented on. If you look at the household wealth ratio, that's gone up tremendously. Normally, you would have expected the consumer sector balance, personal balance, to come down, reflecting that. It just hasn't happened. And we believe that this is about healthcare costs and about student debt funding.
So I'm going to say, ultimately, student debt will be forgiven. It's the obvious policy response. So we will move student debt to the government balance sheet, and that could be one of the great buying opportunities for it.
And that we would view that as being the shift from monetary policy to fiscal policy taking.
I'm afraid we're out of time now, so we're going to have to end it there. Thank you very much to the fantastic panellists. I think we can all agree we've had an amazing array of views today and plenty